Okay, so this week we've seen some fairly interesting things happening in the market, so I thought it would be a good opportunity to ask our senior analyst Ravi Lockyer some questions about what's been going on. So I think, Ravi, the most important thing that's happened is the interest rates and the Fed's decision. So what's your take on it?
Well, I was extremely surprised myself that nothing happened. I was expecting the rates to move up, as we've been told that the decision was data dependent. And the data had been extremely strong, so inferring from the data, I thought that rates would rise quite last night, but in fact they didn't.
Okay, so it was a bit of a surprise.
It was a surprise to me, and it was a surprise to bond investors who immediately marked up the price of bonds all across the yield curve, with particularly sharp increases in the short end. And I think it was a surprise for equity investors too, in that the wording of the statement that accompanied the decision implied a new area that the Federal Reserve was looking at, notably what's happening abroad. And recent months of what's been in evidence has been a very sharp deterioration in the world economy, slowdown in growth, and it would appear that this is now a concern for the Federal Reserve, and it is holding fire until more evidence emerges on the impact of overseas developments on the USA.
Okay, so I mean, what's your opinion on how this is actually going to play out in the markets? How's it going to affect it? Are we going to see rising, falling? What's going to happen?
Well, I think there's going to be a fair degree of volatility in the short term as people decide to what extent the growth abroad is going to be a factor. There's still a lack of clarity on what precisely that growth is. And I think we're in for a period of time where stocks are going to be moving around potentially quite sharply in the short term.
Okay, and is that specific to the UK or is that worldwide?
I think it's a global pattern, and I think we will reflect that to a large degree as well.
Okay, so what would you say, or how would you say this affects the average investor? So, somebody with a portfolio, what should they be thinking of?
Well, the average investor would be probably a little bit lower year to date. We had a very strong start to the year. We had a sort of very euphoric response to the election. Since then, prices have drifted off a fair way, and we've had what could only be described as a meaningful correction, where there's been a repricing. The market has moved down to levels that it is more comfortable with from previous record highs. And my view is that we're now in a relatively narrow channel. I'm not expecting a large move either out or either upwards or downwards. I'm expecting a move within this very narrow range, but at lower levels.
Okay. And are there any specific sectors that will benefit or should stay away from?
Well, the fact that rates didn't rise is negative for banks, in my opinion, because banks normally benefit from higher rates, and certainly the low rates of recent years have caused a problem. So the fact that rates didn't rise when they're expected to is negative for banks. Utilities, high-yielding utilities and anything with a high yield should benefit, as the high yield differential will still be there post this non-move.
Okay, so was it a bit of a much ado about nothing then, or?
No, I think this was a meaningful decision, and it was a very important decision last night. I don't think it was a lot of fuss. I think, frankly, it was a very important meeting. It's now clear that rates are going to be on hold for the balance of the year, and I would suggest it would seem that they're willing to wait well into 2016 for a decision and a move off on rates.
Okay, excellent. Well, thank you very much, Ravi. That's
thanks for your time.
Insight.
Great to be on your show.
Excellent.
Thank you.